Welcome to the Riskwiser Zone, the podcast where we dive into the world of finance and explore the latest developments that shape our global economy. I'm your host, Louis, and I'm excited to have you join me today as we navigate the complexities of trade agreements, tariffs, and their impact on the markets. We're starting off with a big story that's been making waves in the financial world: the recent tariff deal struck between the United States and South Korea. In a surprise move, President Trump announced that the U.S. will impose a 15% tariff on goods coming from South Korea, which is lower than the 25% duty he had initially threatened. This new rate puts South Korea on par with other major trade partners like Japan and the European Union, who have also secured similar deals with the Trump administration. But what does this mean for the global economy? On one hand, the deal provides some much-needed clarity for businesses and investors who have been waiting to see how the U.S. would approach its trade relationships with key allies. South Korea has agreed to buy $100 billion worth of U.S. energy products, including liquefied natural gas, which could be a significant boost to American exporters. On the other hand, there are concerns that this deal may not be as beneficial for South Korea as it seems. The country's opposition party has criticized the agreement, saying that the government made too many concessions and that the terms of the deal may ultimately harm Korean businesses. Additionally, the fact that the U.S. is using tariffs as a negotiating tool raises questions about the long-term implications for global trade and the potential for retaliatory measures from other countries. It's also worth noting that this deal comes on the heels of another significant development: the imposition of a 50% tariff on most imports from Brazil. While some key sectors, such as aircraft and energy products, have been exempted from these duties, the move has still sparked concerns about the use of trade as a political weapon. As we continue to monitor these developments, it's clear that the world of finance is becoming increasingly complex and interconnected. The implications of these trade agreements will be felt far beyond the borders of the countries involved, and investors need to stay informed in order to make smart decisions. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into the world of finance and banking, where Punjab National Bank has just reported a significant decline in its net profit for the June 2025 quarter. The bank's standalone net profit fell by 48% year-on-year to Rs 1675 crore, primarily due to a one-time tax expense of Rs 5,083.3 crore. Now let's take a closer look at the numbers. Total income for the quarter rose 15.7% to Rs 37,232 crore, but net interest income remained largely flat, increasing by just 1% to Rs 10,578 crore. The bank's asset quality showed some improvement, with gross non-performing assets standing at 3.78% and net NPAs declining to 0.38%. We've also got the views of brokerages like Antique Stockbroking, which has retained a hold rating on PNB with a target price of Rs 123, and Motilal Oswal, which has maintained a buy rating with a higher target price of Rs 125. These differing opinions highlight the complexities of the banking sector and the need for investors to stay informed. As we navigate this story, it's essential to consider multiple perspectives and avoid making emotional decisions based on short-term market fluctuations. The Indian banking sector is undergoing significant changes, and banks like PNB are working to improve their asset quality, increase deposits, and expand their loan portfolios. In conclusion, the Punjab National Bank's quarterly results serve as a reminder of the importance of careful analysis and risk assessment in the world of finance. As investors, it's crucial to stay up to date with market trends, regulatory changes, and company performance to make informed decisions. Stay tuned for our final story of the day, right here on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're closing out today's show with a story that highlights the importance of data accessibility and vendor neutrality in the financial services industry. You may recall our previous discussions on the challenges of navigating complex regulatory requirements and the need for transparent, cost-effective solutions. Today, we're shining the spotlight on Smarsh, a company that's making waves with its data freedom guarantee. This bold initiative promises to empower customers by eliminating self-service, data export fees, and regulatory documentation surcharges for professional archive clients. But what does this mean for organizations seeking to future-proof their compliance and data strategies? On one hand, Smarsh's guarantee can be seen as a significant step forward in promoting customer control and flexibility. By removing cost barriers and providing seamless access to archive data, companies can more easily adapt to changing regulatory requirements, leverage AI-driven insights, and drive innovation. On the other hand, some might argue that this move could be seen as a marketing ploy, or an attempt to differentiate Smarsh from its competitors. Nevertheless, it's essential to acknowledge the potential benefits of such an approach, particularly in an era where high-quality data is becoming increasingly crucial for effective AI applications. As we've emphasized throughout this show, it's crucial for organizations to carefully evaluate their options and consider the long-term implications of their decision. Smarsh's data freedom guarantee may be an attractive proposition, but it's essential to weigh the pros and cons, assess the company's track record, and consider multiple perspectives before making any commitments. In conclusion, the story of Smarsh's data freedom guarantee serves as a reminder that, in today's fast-paced financial landscape, staying informed and vigilant is more critical than ever. As we navigate the complexities of risk management, compliance, and innovation, it's essential to remain cautious yet open-minded and to continually assess the evolving landscape. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe. And until next time, invest with caution.